merchant bankers, and some of the services of portfolio management are providing advice on selection of investments, where to invest the money, that advice. Then carrying out critical evaluation of investment portfolio, how the portfolio is performing, whether the portfolio is performing better than the industry average or not, such kind of critical evaluation. Then collecting and remitting interest and dividend on investments, undertaking investments in securities, safe custody of securities in India and as well as overseas also. And finally, undertaking review of provident fund investment, trust investment, etc. So these are some of the services under portfolio management. Then merchant bankers uh, another function of merchant bankers is also working capital finance. So what is working capital finance? Working capital finance is the fund that is required to meet the day-to-day expenses of an enterprise. And what all activities fall under the purview of working capital finance? Assessment of working capital requirements, then facilitating sanction of credit facilities, speedy disbursements of the money. This also falls under working capital finance. Then acceptance credit and bills discounting. So acceptance credit and bill discounting means activities that are relating to acceptance and discounting of bills of exchange and advancement of loans and of all such other instruments. Then merger and acquisition also. Merchant bankers also play a crucial role in mergers and acquisition. So what merchant bankers do is they arrange for negotiating acquisitions and mergers by offering expert valuation regarding the quantum and the nature of considerations and other related matters. And as part of this merger and acquisition, these merchant bankers, they conduct SWOT analysis. SWOT analysis, SWOT stands for strengths, weaknesses, opportunities, and threats. So merchant bankers conduct SWOT analysis in order to help formulate guidelines and directions for future growth. And they have to conduct studies for locating overseas markets, foreign collaborations, and prospective joint venture associates. Then obtaining approvals from shareholders and other stakeholders. Merchant bankers also monitor the implementation of merger and amalgamation schemes. So that is the role of merchant bankers as far as merger and acquisition is concerned. And merchant bankers also undertake venture capital financing. So what is venture capital? Venture capital is a seed capital in the form of equity financing for high risk and high reward projects. So merchant bankers even provide this venture capital financing also. Then lease financing. Merchant bankers also provide lease financing. So leasing is actually one of the fund-based financial services of merchant banker. What does leasing actually mean? Leasing means letting out assets on lease for use by the lessee for a particular period of time. So these merchant bankers, they provide the following services. Providing advice on the viability of leasing, providing advice on the choice of a favorable rental structure. All of them fall under the purview of a merchant banker. Then foreign currency financing. So foreign currency finance is the fund that is provided for foreign trade transactions in the form of export-import trade finance, euro currency loans. So the role of merchant bankers in this regard is that is what merchant bankers do as far as this foreign currency financing is concerned. They assist the study of turnkey projects and construction of contract projects. They liaison with RBI, the Exim Bank, ECGC, that is Export and Credit Guarantee Corporation, and other such institutions. And they provide assistance in opening and operating bank accounts in overseas abroad. They also assist in obtaining export credit facilities and letter of credit. They provide guidance on forward cover for exchange risk. They arrange foreign currency guarantees. They arrange various types of foreign currency loans, such as euro currency loans, syndication of euro loans, bank guarantees. Uh, uh, they're all arranged by merchant bankers. And as far as brokering the fixed deposits, merchant bankers render the following services. So what do? They work out the quantum of procurement of fund in the form of deposits from the public. They draft advertisements for inviting deposits and filing a copy of it with the registrar of companies for registration. They arrange payment of interest amounts, and they also advise on the terms and conditions of fixed deposits of the company. So these are the various functions of merchant bankers. Um, Now let us look at some of the SEBI regulations as far as merchant banking is concerned. Right? So, as per the SEBI regulations, all issues should be managed by at least one authorized merchant banker functioning as a sole manager or lead manager. And as such, only category 1 merchant banker could act as a lead manager to an issue. So, what do SEBI guidelines tell us is for an issue of less than 50 crores, the number of lead managers should not exceed 2. And for an issue of size of 50 crores and more, but less than 100 crores, the maximum number of lead managers should not exceed 3. And for an issue of size 100 crores, but less than 200 crores, the maximum number of lead managers should not exceed 4. And for issues above that, that is 200 and above, but less than 400, the maximum number of lead managers should not exceed 5. And if the issue size is more than 400 crores, then the lead managers may be 5 or more as agreed by SEBI. So these are the stipulations of SEBI as far as the number of lead managers is concerned. Next, let us look at the conditions of registration or renewal certificate of a merchant banker. So, the registration certificate or renewal certificate of a merchant banker is subject to the following conditions. So, prior approval of SEBI is necessary to continue to act as a merchant banker after change of its status, like amalgamation, merger, and consolidation, or any other kind of corporate restructuring, or change in its managing, whole-time directors, change in control, etc. And a merchant banker should enter into a legally binding contract with the issuer, specifying their mutual duties and responsibilities. And the third one is a merchant banker should pay the registration or renewal in the prescribed manner. A merchant banker should take adequate steps for redressal of grievances of investors within 1 month of the complaint. And he should inform SEBI the details of the complaints and the manner of redressal. And a merchant banker should also abide by the relevant regulations under the SEBI Act. There are also some restrictions on business for merchant bankers. So the merchant banker, other than the public or bank financial institution, they are not permitted to carry on business other than in the securities market. That is, he is prohibited for carrying on fund or asset based businesses like leasing or factoring and things like that. Next, coming to responsibilities of lead managers. What are the responsibilities that a lead manager has to undertake? Every lead manager must sign an agreement with the issuing companies. This agreement must contain the matters regarding the mutual rights, liabilities, and obligations relating to issues, which must necessarily include the disclosures, allotment, and refund. And the merchant banker should also furnish a statement that is specifying very clearly the details in the agreement to SEBI. And such statement should be sent at least 1 month before opening of the issue for subscription. And the statement should also contain the details about all lead managers and their respective responsibilities if there were more than one lead manager or merchant banker. And there should be no association between the lead manager and the issuing company. And also, there should be no association with other merchant bankers who do not hold a certificate of registration with SEBI. Then coming to the minimum undertaking obligation. The minimum undertaking obligation to be accepted by a lead manager is 5% of the total underwriting commitment or rupees 25 lakhs, whichever is less. Then the due diligence certificate. The lead manager should furnish a certificate to SEBI 2 weeks before the opening of the issue for the subscription, stating the following. What should it state? That the prospectus or the letter of offer, that document is very much in conformity with the documents, materials, and papers that are relevant to the issue, and all legal requirements in connection with the issue have been complied with, and the disclosures are true, fair, and adequate to enable the investors to make a decision regarding investment. And the merchant banker must submit to the SEBI 2 weeks before the date of filing with the registrar of companies, regional stock exchanges, or both, all the following particulars like draft prospectus or letter of offer or any other literature that is to be circulated to the investors or the shareholders. And for these issues, whether it is public issue or rights issue, the merchant banker has to pay to the SEBI some fee. And this fee changes for public issue as well as right issue. For up to rupees 10 crores, whether it is public issue or right issue, the fees is a flat amount of 25,000. 25,000 is the fixed amount up to 10 crores, whether it is a public issue or it is a rights issue. Now coming to issues, coming to the public issue, which is more than 10 crores but less than 5,000 crores. So for a public issue, the fees is 0.025% of the issue size, whereas for a rights issue, it is 0.005% of the issue size. So as you can see, it is much less in a rights issue. And for issue size of 5,000 crore to 25,000 crore, the fees for public issue is 1.25 crores plus 0.00625% of the issue size in excess of 5,000 crores. Anything above 5,000 crores, they have to pay 0.00625%, right? And if the issue size is more than 25,000 crores, then a flat charge of 3 crores is to be paid. And for rights issue, if it is more than 500 crores, then a flat charge of 5 lakhs is to be paid. Just a minute. Then coming to registration. So to act as underwriters, a certificate of registration should also be obtained from SEBI. No separate registration to act as an underwriter is required in case of a merchant banker who is already registered with SEBI. So for them, it is not required. So this is about merchant banking. Now let us look at credit rating, right? So what exactly is credit rating? Credit rating is an opinion of a rating agency about a debt instrument. So this opinion is expressed through symbols which indicate the degree of risk associated with repayment of principal and payment of interest on debt instrument. So credit and these credit rating agencies, they get fee for their services from corporate entities which approach them for rating of their instruments. So credit rating is not mandatory to all corporate sectors except for certain instruments. And the financial position of all the corporations is reviewed frequently and the ratings are revised by the credit rating agency. So if we look at the origin of credit rating, in the 19th century, the first mercantile credit agency was set up in New York uh, in order to rate the ability of merchants to pay their financial obligations. Uh, uh, this mercantile credit agency was then taken over by Robert Dunn, and this agency published its first rating guide in 1859. And the second agency, it was established by John Bradstreet in 1849, which was later merged with the first agency to form Dun and Bradstreet. In 1933, this became the owner of Moody's Investor Service in 1962. So since the 1970s, a number of credit rating agencies have been set up all over the world, including countries like Malaysia, Thailand, Korea, Australia, Pakistan, Philippines, etc. And in India, the first credit rating agency that was established was CRISIL, and this was established in the year 1987. CRISIL stands for Credit Rating and Information Services of India Limited. Now let us try to understand the rating indications. So these rating symbols that are assigned to a security issue is an indicator of the following. The nature and terms of the particular security that is being issued, the ability and creditworthiness of the issuer of a security to make payments in time, and the probability that the issuer will make a default in payments. Right? So that is the reason why rating symbols are assigned to a security issue. So what are those factors that influence the assigned ratings? So the ratings are assigned by the credit agency based on the following factors. So what are those factors? The issuer's ability to meet the obligations of debt, the volume and composition of the outstanding debt, how much of debt that company already owes to outsiders, what is the composition of that debt, what is the volume of that debt, that aspect. Then the earning capacity of the company and its stability of future cash flows. What is its present earning capacity? How much? What is the potential? What is the potential of that company to earn money in the future? Right. Then the interest coverage ratio. That is the relationship between fixed interest and the profit of the company. whose ability to meet its fixed interest obligations. Then what is the current ratio? That is also one factor that they take into consideration. Current ratio is calculated to assess the liquidity position of the issuing firm. Then what are the value of the assets that are pledged as collateral security? What are and the demand condition? What is the market demand for the products of this particular company? What is the market share of this particular company? What is the competitor's market share? What the nature of the various distribution channels? These are also important factors. Then operational efficiency is also a very important factor. And this operational efficiency is judged by capacity utilization, prospects of expansion, modernization, and diversification, availability of raw material, etc. And another very important factor that is taken into consideration is the track record of the promoters, directors, and expertise of the various staff. Then coming to the benefits of credit rating. The beneficiaries of credit rating, who are the beneficiaries of credit rating? Who actually gets the benefit from it? So, investors get benefited from this credit rating. Companies and intermediaries, all of them get benefited from credit rating. As far as investors are concerned, safety is one biggest benefit that they get. So they get an idea about the strength of the extent of financial strength of the issuer company through the credit rating. Then they also get to understand the risk and returns. See, because what happens is credit rating, it indicates the degree of risk and the possibility of returns on debt instruments. So the indication helps the investor to take decision for making whether to make investment on such instruments or not, and how much investment to make. That also they can decide. And investment decisions also can be taken on the basis of credit rating. So the credit rating symbol, it expresses the credit worthiness of the instruments. As a normal person, as a layman, can easily understand about the risk and return status of such instruments. Hence, he can take his own decisions instead of seeking any advice from the stockbrokers. And deciding their investment choice, credit rating helps that to a great extent. So, see, commonly there are two types of investors: the risk takers and the risk averters. So, the level of risk taking is different for different investors. So, what the investor can do is the investor can choose the securities for his investment based on what is his risk bearing capacity. So, if a particular person's risk bearing capacity is higher, then he would opt for a slightly riskier instruments with a higher return. Whereas if a particular person's risk-taking capacity is low, then obviously they'll choose low-risk instruments with where the returns are also low. And easy perception is possible. Like, all debt instruments, they are rated mandatorily. So no analytical knowledge is required to make investment of debt instruments. So therefore, investors, they can make investments easily and quickly. And these credit rating agencies, they conduct detailed investigation about the issuing company details, like, what is the nature of the business, what are the financial, position, what is the liquidity, profitability position, before evaluating the instruments issued by them. So therefore, investors need not they need not bother to know much about the company. They need not do their background research. All that is not needed. Then coming to the monitoring system, these credit rating agencies, what they do is they continuously monitor these instruments, whatever instruments they are grading. They continuously monitor those instruments, and the issuing companies also, the companies uh, that are issuing these instruments, which general public cannot do. If a person wants to invest 10,000 rupees or 1 lakh rupees or 50,000 rupees in some debt instrument, they cannot be continuously monitoring the company, the issuer company, and about the instruments, because see, they would have a separate job, a profession, or a business of their own. Monitoring this would not be their only job. So this job, if it is taken by somebody else, then life of the investor becomes easy. And that somebody else is nothing but the credit rating agency. Now, these are all the benefits to the investors. But there are also, it is not that credit rating offers benefits only to the investor. Credit rating also offers number of benefits to the company also. Yes. Coming to the benefits of the company, highly rated instruments, they indicate the ability of the yield of the instruments. So normally, any investor would be interested in investing in this kind of instrument. So it becomes easier for the issuing company to mobilize funds quickly through the issue of such type of securities. So it becomes very, very easy for the company to mobilize funds. And those instruments that are highly rated, they usually have a lower rate of interest. So the advantage for the company here is that they can get a cheaper source of debt fund. And the issue expenses also reduced because of credit rating. Because see, the rating itself is an advertisement for highly rated instruments. Hence, the issuing company has no need to spend for publicity of such instruments. So therefore, the issuing cost can be reduced to, uh, as far as the issuing company is concerned. And credit rating also increases the goodwill of the company. When the instruments of a particular company get a higher rating, automatically the goodwill of the company also increases. And these high rated instruments, they build good image of the company in the eyes of the stakeholders. And see, it is also a motivation for growth. So the promoters of the company with highly rated instruments are motivated to expand their operations and move towards the growth path of the company. Another final benefit of credit rating to the companies is uh, credit rating is a way of getting recognition. It is the way of getting opportunity to recognize the new companies or unknown companies, companies which were not known earlier, companies that have just recently started their operations, for them it is easier to get recognition if their instruments get a good credit rating. Then coming to the benefits to the intermediaries, we have seen what are the benefits of credit rating to the individual investors, what are the benefits of credit rating to the firms. Now let us see what are the benefits of credit rating to the intermediaries. So these intermediaries do not have to expend a lot of effort. Less effort is sufficient to approach the investors for selection of instruments by the intermediaries in case the instruments are highly rated. However, in spite of all the benefits of credit rating that we discussed, both from the investor, the company, and the intermediary's point of view, credit rating also suffers from certain limitations. Like, the hidden information. So investors might face a loss when the company does not disclose important information to the credit rating agency. If the credit rating agency is also blind to certain aspects of the company, then that is a damage or loss to the investor. Another disadvantage with credit rating is credit rating does not take into consideration external factors like political factors, economic factors, environmental or government policies, which might affect the credit worthiness of the firm. So these are not taken into consideration while evaluating the instruments. And generally, this rating is based on historic data, which may mislead the investor. So, like, what happened last year, what happened last quarter, that is known as historic data. So most of this rating is usually based on historic data, which may mislead the investors. And another thing is, see, rating is no guarantee. Rating is no guarantee. Rating is simply an opinion about the capability of the company, but it is not like a certificate or guarantee of the credit rating agency. So, like, a credit rating agency gives a good rating to a particular debt instrument, but later it does not perform well. This does not give a right to any person to come and later sue the credit rating agency as to why did you give it good rating and things like that. It is not any guarantee, it is merely an opinion. Then the quality of another limitation of credit rating is that the quality of the rating may be affected due to the personal bias of the investigating team. One particular team could be very favorable towards a particular sector or towards a particular company or towards a particular kind of debt instruments, so which might affect the overall rating as such. And many a times what happens is different rating agencies give different rating scales for the same instrument. So this could cause a lot of confusion in the investors. Okay, next let us look at the regulatory framing for credit rating agencies. What is the regulatory framework for credit rating agencies? The Securities and Exchange Board of India Regulations 1999. These regulations empower SEBI to regulate the credit rating agencies operating in India. In fact, SEBI was one of the first few regulators globally to put in place an effective and comprehensive regulation for these credit rating agencies. SEBI regulation for credit rating agencies has been designed to ensure the following. So credible players enter this business, and how is that done? Through stringent entry norms and eligibility criteria. So entering into this business is not that easy. And credit rating agencies operate in a manner that enables them to issue objectives and fair opinions. And this is possible through well defined general obligations for the credit rating agencies. And there is a widespread investor access to ratings. Uh, and that is possible through a clearly articulated rating dissemination process, which is very clearly established and informed to everybody. And then the applicant should be registered as a company under the Companies Act 1956, and it must possess a minimum net worth of rupees 5 crores. So these credit rating agencies are amongst the very few market intermediaries for which such detailed operating guidelines have been prescribed under the regulations. Everything right from the code of conduct, agreement with the client, monitoring of the ratings, procedure for review of rating, internal procedures to be framed by the CRA, disclosure of rating definitions and rationale by the CRA, submission of information to the board, compliance with the circulars, appointment of a compliance officer, maintenance of book of accounts records, confidentiality, rating process, all of them are prescribed under the regulations. So the SEBI's code of conduct for these credit rating agencies addresses some of the basic issues relating to the conflicts of interest. So the code of conduct is designed to ensure transparent and independent functioning of credit rating agencies. And some of the salient provisions of the code of conduct are: a credit rating agency shall make all efforts to protect the interests of the investors. And then a credit rating agency at all times should exercise due diligence, it should take proper care, and it should exercise independent professional judgment in order to achieve and maintain objectivity and independence in the rating process. And it should have in place a rating process that reflects the consistent and international rating standards. So they have to follow that as well. And a CRA should keep track of all important changes that are occurring in the client company, and they should develop efficient and responsive systems to yield timely and accurate ratings. The credit rating agency shall disclose its rating methodology to clients, to users, and also to the general public. So in India, the regulating authority for credit rating agencies and financial instruments are SEBI, RBI, and IRDA. So for public uh, um, public's issue, rights issue, or listed issue of bonds, SEBI is the regulator. For IPO grading, for capital protection oriented funds, for uh, um, even collective investment schemes of plantation companies. For all these instruments, SEBI is the regulator. But for commercial papers, RBI is the regulator. For bank loans also, RBI is the regulator. For security receipts, RBI is the regulator. And for securitized instruments, that is pass-through certificates. So RBI, Basel II capital computation for banks, that is also required. Then fixed deposits by NBFCs and housing finance companies, HFCs, RBI is the concerned authority, is the concerned regulator. Then LPG or SQO rating, Ministry of Petroleum and Natural Gas, they are the regulators. Then investments by insurance companies, right? For investments by insurance companies, IRDA is the regulator. For provident fund investments, Government of India is the regulator. So some of the Important credit rating agencies in India are CRISIL, ICRA, CARE, Fitch, Fitch India it is called. They are some of the important credit rating agencies in India. So CRISIL is the first rating agency of India. It was set up in 1987 jointly by ICICI Limited and UTI. And the other shareholders in CRISIL were ADB, that is the Asian Development Bank, LIC, State Bank of India, HDFC, etc. And the head office of CRISIL, it was located at Mumbai, and it also had established offices outside India also. Then ICRA stands for Investment Information and Credit Rating Agency of India. ICRA was established as a collaboration of financial institutions, investment companies, and banks. So the company, some of the objectives of ICRA are to rate rupee-dominated debt instruments and to take up assignments for credit assessment of companies. It provides services of general assessment to undertake research-based study reports. So these are some of the objectives of ICRA. And CARE is also another important credit rating agency of India. CARE stands for Credit Analysis and Research Limited. CARE was promoted by IDBI, Canara Bank, UTI, and some other financial and lending institutions. So these are some of the important credit rating agencies as far as in our country it is concerned. Next, let us look at depository services. What do you mean by depository services? So what exactly is a depository? So a depository is a financial institution that holds and facilitates the transfer of securities in electronic form. Electronic form, it is also known as a DMAT form. DMAT is the short form for dematerialization. So a depository in stock market plays a very important role in serving as a centralized custodian of dematerialized securities like stocks, bonds, mutual funds, right? So the depository meaning refers to an entity that allows investors to store their financial assets in a secure and convenient manner. And this enables smooth buying, selling, and transferring of securities without the need for physical certificates. So understanding the concept of a depository is essential for anyone interested in participating in the stock market or investing in financial instruments. Understanding what is depository in the stock market is very crucial for investors who are seeking to safeguard their securities and streamline the process of trading and settlement. So a depository, depository, that is a financial company that maintains financial securities in a dematerialized state. Here, transactions such as buying and selling shares happen without any physical movement of the assets. So special intermediaries called DPs. DPs are depository participants. They enable investors to buy and sell securities through the depository. So the depository keeps investors' securities like stocks and mutual funds in an electronic form instead of physical certificates. So this reduces paperwork and it prevents the risk of physical certificates getting lost or stolen. It also makes purchasing and selling of securities quite easier. So apart from holding securities electronically, these depositories also provide services such as keeping records of the mutual fund units that are owned by the investors, settling the trade transactions, and handling corporate actions like dividend payments and bonus issue of shares. Coming to the benefits of depository system, the advantages of depository system is that they help investors perform trading activities effortlessly without a lot of effort. They provide a safe and efficient way to hold and transfer financial securities electronically. So the key benefits make investing more convenient, cost effective, and accessible compared to dealing with physical certificate documents. So some of the uh, uh, notable benefits of depository system are convenience and security. So a depository account, a demat account, it allows you to hold your stocks electronically instead of with physical share certificates. So this can be very, very convenient for conducting transactions like buying and selling shares. And it is also more secure since there is no risk of losing or no risk of any damage happening to the physical certificates. Then the next biggest benefit of a depository system is the time that is saved. So with a demat account, you can buy or sell shares uh, much faster when compared to paper share transactions. So transferring physical shares can take several weeks, whereas electronic transfers that they happen instantly within seconds. And then another benefit of depository services is cost effectiveness. Uh, so the cost of maintaining a demat account is much less than holding physical certificates, which they require expenses like stamp duties, and then if you have to keep it in a bank locker, then you have to pay the locker rental fees. All those things are considered. So therefore, maintaining shares in electronic form is any day less expensive when compared to maintaining shares in the physical form, the paper format. And also, any investor can very easily log into their demat account anytime. They can view their portfolio holdings and also they can look at all their transaction details and they can get regular account statements also. That is also possible. The securities uh, that are held in a demat account, they can also be used as collateral for loans. So when an individual investor wants to apply for a loan from a bank, he can use the securities that he has as a collateral, and so this makes the loan approval process much quicker when compared to using physical shares. Now the next thing that we need to know is, are there any depository charges? See, when investing in the stock market through a depository system, the investors might have to pay certain fees known as depository charges. These depository charges apply under different circumstances. One common situation where you would face these charges is when you buy or sell securities using your demat account. In such cases, your depository participant um, will charge a fee. And before the charges reach the investor, the depository participants themselves will first have to pay the fees directly to the depositories. So there are two depositories in India, NSDL and CDSL. All these DPs, the depository participants, are registered with either of them. either of the depositories. And then these depository participants then pass on these depository charges to the individual investors as their clients. So, let us try to understand the types of depository systems in India. Uh, Types of depository systems in India. So CDSL and NDSL are two different types of depository system. CDSL stands for Central Depository Services Limited and NSDL stands for National Securities Depository Limited. CDSL was established in 1977 and it began its operations in 1999. It is headquartered in Mumbai and it provides depository services to investors through its network of depository participants that are spread across the country. NSDL is also started its operations around the same time, but 1 year before. So we can say that NSDL is the oldest depository in India. It was set up as a joint venture between IDBI and NSE, the National Stock Exchange of India. And NSDL's head office is also located in Mumbai. So these are the two important depositories systems in India. Now, let us look at how does this depository system work. Say, to buy or sell shares in the Indian stock market, first an investor needs to open a demat account or dematerialized account. After opening this account, they can trade shares online. So just now, like I told you, in India, we have two prominent depositories, NSDL and CDSL. So these institutions operate under the regulatory purview of SEBI, ensuring adherence to established protocols and standards within the financial domain. So these depositories, they appoint agents called depository participants, like banks, brokers, and other financial institutions. So these depository participants, they maintain investors' accounts and handle the settlement of trades. And an investor's demat account with the DP shows their shareholding in the electronic form. And to open a demat account, the investor fills out forms with the DP, the depository participants. When they buy shares, this DP credits the number of shares to the investor's demat account electronically. No physical share certificates are issued. Similarly, when these shares are sold, what the DP does is DP debits the shares, the number of shares from the demat account. And this demat account holder, being the real owner of the securities, he is known as the beneficial owner. So all buying, selling, or transferring, it happens by making entries directly in these electronic demat accounts without any physical movement of shares. There is no movement of shares anywhere, share certificates anywhere. And investors, they get regular statements from the depository participants showing what their current holding position is and what are their transaction details in the last 1 month or 1 quarter or whatever it is. Next, coming to functions of depository. So the depository performs several functions. This includes dematerialization of securities. So dematerialization is nothing but converting physical share certificates into digital or electronic files. So what it does is it makes it much easier to hold, transfer, and trade securities. Then faster trade settlements is possible. So when investors buy or sell shares, the depository settles these transactions quickly by transferring the securities from the seller's account directly to the buyer's account within a fraction of a second, because everything is done electronically. And these depository participants, their function is not just to hold shares in electronic format, but they also handle other corporate actions like, distribution of dividends, issuing bonus shares, recording changes in the ownership, shareholding patterns. All this are taken care by the depository participants. And apart from shares, the depository also maintains electronic records of investors' holdings in mutual fund units also. Depository participants not only simplify the process of buying or selling shares, but they also simplify the process of buying and selling mutual fund units also. And these depository participants, they facilitate collateral. That is, investors can pledge their electronically held securities as collateral when they're applying for loans from banks and financial institutions through the depository system. So, what we can say is that depository services are essential to the financial markets. These services, they offer a secure and an effective way to store and transfer assets, and which lowers the danger of physical certificates being stolen, lost, or even damaged. And also, uh, additionally, uh, this service, it lowers the transaction costs related to the actual transfer of securities. So the depository also encourages the financial markets efficiency and openness. It gives investor access to real-time data on their stock ownership and trades, and increasing transparency and lowering the possibility of fraud. So the depository also facilitates the integration of the financial markets. It allows investors to access securities markets across different regions and countries, which increases liquidity and diversifies investment opportunities. So we can conclude by saying that the depository system has simplified the Indian stock market investment process. It guarantees transaction security, and it provides securities to investors wherever necessary. So, as a result, what is happening? The stock market's digitization has decreased fraudulent trades. There are many stock market apps available for investors, which now allow them to access the trading space from anywhere in the world. However, it is suggested to conduct proper research and compare competitors before downloading an online trading app. And this will help an investor to make informed decisions regarding all the aspects related to the trading world. Right? So, with this, we conclude our discussion on depository services, and we conclude this session where we covered three topics, that is merchant banking, credit rating, and depository services. Thank you.